Our next guest says many of them had little room to mitigate this fallout. Deficit and debt levels, as we remind you on this show, have never been higher, which may have prevented certain governments from cushioning the impact. Countries like the US, the UK, Japan, and Canada face high debt and GDP ratios, giving them less room to help their citizens in an economic emergency. Ruchir Sharma is chairman of Rockefeller International. His latest book, What Went Wrong with Capitalism, argues that a century of expanding governments has distorted financial markets, fueled inequality, and buried America in debt. Mr. Sharma now joins us from Miami. Good to have you on the program on what is a momentous day from the market. But there is one data point that you highlight that caught my attention, that despite the dramatic drop in energy prices today, futures give a better indication of the long-lasting expectations of this shock. I mean, you say that, look, December futures are up. What does that tell you about the tail of this thing?
Well, I think that we pay too much attention to the spot price, which gets a lot of the media. But what the equity market and other market participants discount is really what's happening at the longer end of the curve as far as oil prices are concerned. Now, the longer end prices are still up 15% from when the crisis first broke out. But it also explains why we did not get a sharper reaction in the equity markets when we saw such a large spike in spot oil prices, because spot oil prices nearly doubled, as you know, at the height of this crisis. But the futures always kept telling us that, yes, there is a supply disruption, but it's likely to not last, and that oil prices will end the year higher, but nowhere close to what the spot prices are doing. So therefore, I keep a firm eye for what the December futures in particular are doing for both WTI and Brent. And even those today are little changed, partly because they've been correct in sort of saying that this is a temporary dislocation, it won't last, but prices will settle higher from where they were before the crisis.
Yeah, and the point is there is no returning to where we were before this conflict. You also write that a few days ago, the global economy, even a few days ago, the global economy remains extremely vulnerable. Can you explain that? How so?
Well, I wrote this op-ed for the Financial Times on Monday, essentially arguing that this oil shock is different. That so far, we heard a lot of analysts tell us that the oil sensitivity of the global economy has reduced, basically meaning that the global economy now is more energy efficient. It takes less oil to grow at the same rate. And also the fact that oil consumption in general, because of that, has come down as a share of GDP. So that means that higher oil prices don't hurt the consumers or even the businesses as much as they used to. I had a slightly different take on that while that's true, this oil shock is also different because there is very little policy ammunition left with policymakers, that we have never entered any crisis with such high debt and deficit levels. And also that many central banks around the world, led by the Fed, had been running very high on their inflation targets, much higher than whatever the inflation target was, meaning that there was very little room for maneuver here, that if the governments wanted to spend more to cushion the economic impact of this oil crisis, they wouldn't be able to do much. And that's why, unlike past crises, this time, in fact, interest rates, bond yields around the world rose quite sharply. There was no real safe haven bid for bonds this time. And that is mainly explained by the fact that you have concerns about the debt and deficit looming. And the longer this conflict went on, more pressing would be those concerns and tell on the bond market.
Sure, I'm not exactly sure that any governments are listening to you right now in terms of the dangers of this, but that is then to the central bankers, most of which are independent, right? If we're in this context of higher for longer, does that, though, really handicap the central banks as well? Because if we assume a bumpier recovery from all of this, how can these economies run this out? Are you looking to the central banks, or is it really going to take what you say, which is more insulation, more insurance on the energy shock?
Well, I don't think the central banks can do much either, because the Fed, of course, is the most dovish of them all. It has missed its inflation target now for 60 months in a row, 6-0. And I think that the Fed now is in no position to cut interest rates this year. So I think the Fed is out. The ECB and the Bank of England were talking about possibly raising interest rates if this oil shock had persisted. And many other emerging market central banks like Philippines and all were also talking a very similar language. So this is very different. In the past, when you got any shock to the economy, the central banks would rush to the aid of the economy in the slightest hint of trouble. I don't see that happening this time. And if this shock lasts longer, therefore, you don't have much policy ammunition to deal with, because even on the fiscal side, I think there were countries trying to give some subsidies, but the bond markets this time aren't tolerating that. This time bond yields are rising. So I think that's the big difference, as you know well, that the doomsayers have been around a long time worrying about the debt and the deficits. And the question many people ask is, so what? That the bond market's not really reacting to any of this. That's changing now, which is that this year, this crisis, we saw that bond yields actually rose during the crisis. They did not fall. And the rise could entirely be attributed to concerns about the debt and the deficit, because long-term inflation expectations were pretty stable. So those didn't move. Obviously, there was some other concern. And the only concern that can explain the rise in bond yields since the crisis began is the mounting cost of the debt and deficit coming directly from the war spend, but more from the fear that governments are going to spend more, and that is not something they can afford to do in a situation where the debt and deficit levels are so high.
Yeah, there has been zero talk of really trying to get any of those budgets in line or to shrink them at all. In fact, there's only been announcements about more spending. Sharma, we do have to leave it there, but I thank you for your insights.